Hello, everyone, and welcome to today's webinar. My name is Jonathan Brandt, and I work with Peak Trust Company. I am honored to kick off the first installment in our four-part series focused on private retirement trusts. Few housekeeping items here. If you have a question, please use the Q&A panel to submit your questions at any time throughout the session. Questions will be answered live throughout the session, and if we don't get to all of them, we will follow up after the webinar. For those of you who may not be familiar with us, Peak Trust Company, we are a leading provider of sophisticated trust solutions for high net worth families and their advisors. We specialize in directed trust administration, and we're proud to offer options and flexibility for administration of trust structures for clients across the US and internationally, and the top jurisdictions of Alaska and Nevada. Our goal is certainly to empower planners and their clients with the tools and expert resources needed to achieve the complex estate planning goals that they're designing. Today's session, we will explore the statutory framework and practical implementation of private retirement trusts under California law. This is a unique planning tool with significant asset protection potential for California residents, and we're excited to provide this educational opportunity to deepen your understanding of how that works. To lead us through this topic, I'm pleased to introduce our speaker, Dustin Nichols. Dustin is the founding attorney of the law office of Dustin Nichols. He is a recognized leader in the field of exemption planning and has developed a robust methodology for designing, implementing, and administering private retirement trusts. His expertise lies in combining litigation risk analysis with traditional retirement modeling to create powerful protection plans tailored to the unique needs of each client. You'll find today's session practical and rooted in real case experience, and this presentation will lay the groundwork for the rest of our four-part series. And with that, I will hand it over to Dustin.
Jonathan, thank you so much for that flaming introduction, and thank you, Peak Trust Company, for allowing me to share some of my knowledge on PRTs with the viewers. And like I said, it's truly an honor. I've been practicing law for over 30 years, principally in the areas of estate planning, business planning, done some bankruptcy work, and what I consider a niche, exemption planning, something that's often overlooked and misunderstood. Exemption planning, being what it is, a subset of really asset protection planning, it's the first line of defense that we all have. And given whatever state that we reside in determines what exemptions will apply to us should we ever need to assert them because somebody's trying to collect on a money judgment or otherwise. So it's important to understand that these statutory rights exist, and they are truly your first line of asset protection. And if you've ever worked in the bankruptcy setting with bankruptcy lawyers or in workouts with settlements, you know that ultimately what matters is what's exempt and not exempt on your balance sheet that carries the day. Now, exemption planning in California, why do we need it? Why is it important? California, as we know, is a hotbed for litigation. We are the #1 judicial hellhole in the nation, according to the American Tort Reform Foundation, which is always a wonderful thing, esteemed labeled to bear. But it's a reality. In 2024, I think it was over 67.5 million total state and federal filings in the courts, criminal, bankruptcy, civil, all around the nation. 40 million of these were all civil lawsuits. 65% of those were filed in New York and California. So we are just thrown right into the middle of this, what is a potentially contentious, I should say, environment, one that requires some thinking to be able to truly do some good for clients and protect some of their assets just because of where they are. And these exemptions, they're state law created rights. There's, like I said, they're legislated. It wasn't us that made it up, came up with it. It's what they gave us to use. And we just need to learn how to use them more efficiently. And every state has their own, and they have their own amounts. And California wasn't always known for things like homestead. But the homestead exemption here in California has improved dramatically. It is a constitutional exemption, which means basically the barrier to entry is very easy. You can use it at any time. It exists automatically, but you can impair it. Don't want to do that. We'll talk a little bit more about that later. But it's important that we not give away the gifts that we've been given. And exemptions are truly gifts. And we want to maximize and use them to the greatest potential possible and not necessarily have to disrupt a client's world in creating structures that utilize exemptions for their benefit. Now, there is one thing that I did want to mention, that there is a new law in California. It's AB 2837, and there's some confusion, I think, amongst practitioners about specifically what this law did. It was signed by Governor Newsom in September of 2024, became effective in January of 2025. And it did make certain changes to California's enforcement of judgment laws, including the PRT statute, 704.115 of the California Code of Civil Procedure. Good news is at least the changes that were made to this particular statute don't include PRT. In fact, it's now raised it to a level where it should be considered more important, because now these other plans that were affected by this particular statute, they now have diminished exemption protection. And exemption, if I hadn't already mentioned, exemptions are important because they protect the assets that particular category refers to, that exemption category, from the ability to execute money judgments on. That's, obviously what we're all talking about when we talk about asset protection. But prior to AB 2837, distribution from tax qualified plans, such as the 403s, the 414s, for Comp 457s, they were protected. And they were protected under the same statute that the PRT dwells, so they coexisted and received the same benefits of all money in being exempt, all distributions coming out at the time for distributions are exempt, and the death benefit. But fortunately, this particular law relegated 403s, 414s, and 457s to the protection afforded to IRAs under subsection E of 704.1, and that's really no protection, which means they're now, those particular plans and distributions and such are now subject to means test. And means test, for all intents and purposes, is not a good threshold to protection for debtors. It means basically it's necessity for support. If you can make $1, basically the courts can turn over those assets. And so it's real important that when you're looking at retirement plans, you just don't consider all tax qualified plans must be ERISA protected. That's not true. In fact, I hear that a lot. It's government plans, charitable plans, the 403s, the 414s, those don't get ERISA protection. They're not ERISA protected. They may be tax qualified. So they really rested and relied upon the statute, 704.115B, the PRT statute, for their protections. Now they don't have them. While means test isn't going to help the debtor now under the new law for those plans that I mentioned, we still have some hope. At least the anti-alienation provisions still protect the money in these qualified plans, even if they're not ERISA. There's some hope. They can't break through them. They can't take them. But distributions are certainly at risk. And bankruptcy may provide better protection. And I'm actually on a panel right now with Mike Nicastro, the Honorable Retired Meredith Jury, and Jerry Botwell, ERISA attorney, and we're working through these to show exactly how bankruptcy would be a potential option for better protection in situations where this new law now affects the protection to the participants in these plans. The great news is for PRTs, they continue to provide what I call the trifecta of retirement exemption protection, which is the protection of the assets in the plan, the distributions from the plan, and the death benefit at the time when the participant passes. The exemption that we're talking about that's specific to the PRT, we should probably walk through for a minute and just take a look at, like I mentioned before, it's California Code of Civil Procedure 704.115B. And the language is very specific. All amounts held, controlled, or in the process of distribution by a private retirement plan for the payment of benefits as an annuity, pension, retirement allowance, disability payment, or death benefit are, quote, exempt. Exempt from what? Money judgments. The purpose of the exemption, but it's also important to understand, like I said earlier, that exemptions are not all created equal. We need to look at what kind of exemption it is. And this is a statutory exemption. And the statutory exemption does have barrier to entry. We're going to talk about that. Now, unlike the homestead, which can file a homestead declaration at any time, even in the throes of a judgment collection, and it's not an avoidable transfer. Why? Because it's already a protection afforded by statute, existed and pre-existed any of those issues. And the statute says that. And the case law is extremely liberal. But the PRT is different. It does have a barrier to entry. But its purpose is no different than the others, and that's to protect the debtor from his or her creditors. In this case, well, to protect those retirement assets that are going to sustain and maintain the lifestyle of the participant through their end of their life, their retirement. And this process involves what I call a purposeful conversion. That's how it's referred to in various cases, including the Stern case, which is the Ninth Circuit case that made it clear in that particular case that the purposeful conversion from non-exempt to exempt is not fraud per se. Obviously, that doesn't mean you could just last minute throw a bunch of assets into the PRT when you're being sued out of existence and it's going to work. That's not obviously what it was intended to convey, but it's just treated differently. And especially when you're planning properly and you're recognizing and respecting that there are creditors out there, that there are potential contingent liabilities. These things cannot be ignored when you're clearing the landscape for any planning. But in this case, very important to the PRT, we have a clear path. But it allows us, though, to identify those assets on the balance sheet, on the exposed balance sheet, that are really retirement assets that are going to sustain and maintain that retirement need through the end of the participant's life. It allows it then to convert it to what's called exempt private retirement assets. That means protected retirement exempt balance sheet under this statute. It's very powerful. And these exemptions, PRT included, have to be construed by the courts in a light most favorable to the debtor. There's almost inherent forgiveness in these. And if you read the cases, you'll see that judges try to bend over backwards to make even the most egregious of circumstances work. And obviously they don't if they're egregious. But the point is, you don't really see that anywhere. That shows you the nature of these animals, that they're to be looked at and to be treated and respected, right, a little bit differently. And I think it's real important, as I mentioned before, that you don't ignore them. If you're in the area and you're practicing in an area where it's even implied that you're talking about protection of any kind, then these should really be raised, the exemptions, so that the clients understand and know that these are things they need to look at and utilize first. The additional PRT features, if you do it right, like I said, you clear the path, you identify any issues, creditors, contingent liabilities, and you create a PRT, as long as it's designed and used for retirement purposes, it's 100% exempt, including, like I said, the distributions from the plan. Now, like anything, there are exception creditors. And the three that are mentioned in the statute are obviously the IRS. That's no shocker. Judgments for child, family, and spousal support. Now, what this doesn't get into, which is a little outside the scope of this particular series, is what happens. But what about the three agency creditors out there, or what I should say, judgments from three-letter agencies? That's better put. Those are different when we're dealing with disgorgements and not necessarily judgments. And so the key here is to remember that exemptions apply and protect against, quote, money judgments that can be derived in all kinds of various ways, right? So it's real important that be understood that exemptions, while very protection oriented, they do have some limitations not created by them, but usually the circumstances surrounding whatever the case is. And say for the case of an FTC action that claims that money was illegally taken and then used, and then it's a disgorgement judgment, which really it's money basically that was never the client's to begin with. You can't assert exemptions against something you didn't ever have. That's an example. Protection benefits, though, like I said, in principle, on standard money judgments, if we set up and administer these, in other words, we respect the plan that's created in there and the rules that we've also created in there, the PRT can protect appropriately funded assets from, federal and state court judgments, bankruptcies, and civil judgments. Then we can protect all plan values during growth and accumulation. All right, important that understood that PRT has an accumulation requirement. We have to fund both with some lump sum and gradual accumulation, but that growth and accumulation is protected. To protect future contributions, we say here using secured promissory note, really what it is, it's a contribution promise that satisfies the accumulation requirement. That's the Barnes case, by the way. And when we get into the series, I think it's part 2 or 3, that we get into some case law that backs up some of these requirements. Accumulation is one, gradual accumulation under the Barnes case, that satisfies this, but it also helps to do some things neat, like potentially protect the excess equity in the principal residence of the client's house over the homestead exemption and any loans. We use what's called a defined benefit funding agreement. The client basically makes a contribution promise of X that maybe somewhat correlates with the amount of that excess equity in that principal residence. And then we put a lien on the property in favor of the PRT, which puts it in a first secured position. And the client makes annual payments respecting the obligation. Maybe it's a 20-year promise. And we also have a homestead exemption savings clause in our agreement that ensures that if the value of the property goes down, that we're leaning in favor of the contribution promise, which has a fixed number on it, that we never impair the homestead exemption. If the value of the property goes down, it moves with it. It goes up and down. I think that's important. But anyway, those are just some bells and whistles that help to just make this more efficient and thoughtful. And also the protection of the plan funds after distribution. The PRT at retirement starts making payments to the participant, and we set up what's called a separate PRT distribution account. It could be held in the title and name of living trust with just a notation. These are PRT distributions. You don't commingle that with any other money. And if something ever happens down line and that money's coming out to the client, there's unfortunately a bad situation and there's a collections, they can't touch that money in there. And they can't touch the money coming to it, and they can't touch it once it's in there. So client would be typically using their exposed money outside of the PRT distributions first, right? It's like in estate planning, we want the client to use their exposed cash that's in their estate before they ever had to do anything with respect to the planning that they put into place and drawing money in loans or whatever from IDITs or ILITs. And then the death benefit, and this is key. People ask me, when would the death benefit protection really ever apply? Think about it this way. You're driving down the road and it's foggy, it's at night, and you're playing with your phone because you got text messages coming in, and all of a sudden you cross over the yellow line and God forbid you hit this guy coming at you from the other direction head on, and you kill him and you die in the process. Now his estate is going to file a wrongful death claim against your estate. The PRT passes pursuant to the assets inside of it pass pursuant to a beneficiary designation that can be custom drafted and go to other trusts created that are irrevocable trusts in existence or otherwise. But we always like to integrate some good estate planning with our exemption planning, and that money can go, or assets can go, into this trust bucket outside of the reach of any claims to the estate, which it can be a very powerful planning tool, especially for high net worth clients. The additional PRT features that we can look to that really shine, again, that recharacterization from non-exempt to exempt versus fraudulent conveyance, which is straight transfer planning. There's no inherent almost forgiveness. They have to construe the light most favorable to the debtor. There's none of that in straight traditional transfer planning. So that's the thought. Allows for trust loans to help maintain cash flow. We like people to not mess with the PRT money if you can help it, but I've had clients with a lot of cash sitting on their exposed balance sheet that could be better put to use in the PRT to be loaned back to the company and make some money from the company on it, and at the same time maybe secure some assets in the company in favor of the loan that puts the PRT again in a secured position, maybe some accounts receivable, some equipment, the company, things like that. So it's about that smarter thing, planning smarter, not harder, because we're not subject to ERISA. We don't have the prohibitions, penalties, restrictions, the jurisdiction of the Department of Labor, and any of the compliance and reporting requirements that exist in ERISA. So none of that is part of the PRT platform. There's no participation requirements. Again, you can offer it to, it's usually the business owner, because this is a business-sponsored retirement plan. That's the business is the settlor, but it can be just for the owners, the business owners, shareholders. It can also be for top executives under the top hat exemption of ERISA rules. So that's what allows us to do that. The client can self-direct the plan assets, investments, taxation. That's done typically through a Nestor investment advisor, because the client can't really have any direct control over the investments or managing the trust, because that would blow the anti-alienation provisions that are in the trust that render the trust, quote, an excluded asset from bankruptcy, which is a very important point, because that means that it's not subject to the jurisdiction of the bankruptcy trustee. It doesn't mean they can't try and haul it in if there's something funky going on around it. But traditionally, this is outside the jurisdiction of the trustee construction because of these these features. And if people get cute and want to mess with that, I wouldn't want to, because that's a powerful attribute of the PRT, is that it is excluded from bankruptcy. It's tax neutral, is a disregarded entity for tax purposes. It basically falls under as an employee grantor trust under 678 the IRC, and because it's set up by a third party, and all the income tax benefits. The client has some solar investments, PRT can invest, it gets a return, and client gets tax credits. Also, cost segregation studies that are done on real estate, where the client gets a tax credit, advanced depreciation, that will allow for some tax planning in the PRT with assets that have gone into the PRT that are obviously doing their job, creating a retirement benefit. So that's just some examples of anything you can do. The PRT basically can benefit you from, because it can do whatever you can do, because it's just you for tax purposes. Now, we have a process that basically I think is important to look at and review and understand the thinking behind. It allows us in stages or phases to be able to complete these engagements efficiently, effectively for the client, and even to the point where it may not make sense given we run into a barrier. So we like to flush stuff out ahead of time to know when we're doing these that the client is an appropriate candidate for one of them, and we're doing the right things as practitioners on top of that with our professional responsibilities. So first, we have a due diligence engagement that involves an exemption asset analysis. We spreadsheet everything based on exemption categories, asset categories, and we run it through our calculator. We have a litigation analyst that takes a look at any claims that are threatened, pending, or expected. We run third-party searches, same service bankruptcy attorneys use to flush out creditors and any judgments. And we search for, and it's third party, we search for lawsuits and things that may be pending. We want to identify all of those things, because if there are anything, or if there is anything there, then we want to be able to plan and establish a contingent liability so as to not potentially trip a landmine later where the client could be accused of doing something like not respecting the rightful entitlement of a creditor. And we have an engagement once everything is cleared in phase one. We also look at operating agreements, business entities, just things like that to know what our landscape is that we're working with, because a lot of that will need to be repurposed for PRT purposes. And if you're a practitioner and that's your area and you do those things, it's not my intention ever to step on your shoes. That's stuff that you can do, and I'll help work with you. The PRT is my thing, and I'm happy to work with other lawyers and help them produce more business as well, just so you know. Again, phase two PRT engagement, once we figured out we can clear a landscape, create the PRT, it starts with a retirement appraisal, creation and implementation of the PRT, and the administration actually starts when the client signs their PRT documents. And so administration commences at that same time, and every year it's annually administered. And I'm going to go through these in a little bit more detail. So let's start with in phase one, the exemption assessment analysis. What is that? What does that include? And again, there is the calculator, the pre-exposure, and the post-PRT protection potential, as we call it. It's a 2-page report. But part of the analysis, the assessment, involves lifestyle and assets. They're going to look at a lifestyle expenses, what you have, what you're going to need to keep those assets. Solvency review, this is huge. So when we do that litigation analysis, we're doing it for the purposes of disclosing that, and the representation, the client's solvent. Because if the client's not solvent, they can't do this. It's just a bottom line. And I think that's pretty much with anything. Because in court or in mediation, when I'm always asked, was the client solvent when they entered into this? And if the answer is yes, you better be able to show it. So we have an affidavit, we have a net worth statement that goes attached to the affidavit. You have your traditional Money Laundering Act disclosures and things like that. But then if there's any claims, we literally disclose those in a letter that shows the analysis that went behind the thinking and the case law precedent that helped create the guidelines to give us some sort of a contingent liability. So we respect this potential rightful entitlement of a creditor. So that allows us then to plan around it. Obviously, it's always better if all the waters are clear and there's nothing going on. We would always prefer, but there's just sometimes it's not feasible. We have clients that are doctors that have 5 lawsuits against them at all times just because they were part of a doctor group that never even saw a patient. So it's not reasonable to think they can't do anything. So that's another discussion. Certainly that could be more one-on-one if anybody's interested. The retirement appraisal and plan. This is the engine, the guts of the PRT. It integrates the exemption diagnostics with the traditional retirement plan modeling that goes into this. The resulting calculations prove up the need, right? And that ultimately gives us the ability to draw the box that says, this is how much we can put in this thing. And what is it going to be comprised of, right? And more than anything, and I found this very effective, is that in the front page of our PRT plan report, our retirement planner basically prepares what I call a retirement story. It basically is in simple English. So if a judge ever needed to read it, he could see this was put in here for this reason, and everything in there that was put in there for what reason, to help very simplistically set forth the funding matrix. And then behind it is all the numbers and everything, the Monte Carlo simulations, the standard deviations, the actuarial analysis, all of that's, in my opinion, the most important thing, because if it ever came down to it, it's that expert that's going to take the stand to say this is why everything is in here and how it's retirement and what it does and how it's needed. But the story really sets the right tone for what's here and why. The actual creation of the PRT, we didn't get a lot of guidance from the statute. So case law really is the only guidance that we have, but it's a lot. It's like following the breadcrumbs. There's over 50 years of it. And if you study it, you'll see certain things pop out. And so we created our ingredients basically that are from the case law. We pulled from the case law, and a recipe is as follows. We have one plan per company adopted by the company. We have one trust for each employee. Got to be an employee to be eligible for a PRT. You have to get a W-2 of some kind. It doesn't have to be a huge amount, but you do have to get something. It must be sponsored by, the PRT has to be sponsored by the employer company. Again, settled by, so we don't have that self-settled trust issue. Managed by an independent trustee. We talked about that. Provide retirement benefits only to an employed person. That's that employment requirement. And again, can be ERISA or not, ERISA qualified or not. In this case, we don't do ERISA qualified plans, but it still has to have, or I should say, maintain certain attributes that provides basically the overview of a retirement structure. And to do that, we have to have at least a schedule or formula of payments to be made to the plan by the employee. That's that gradual accumulation component I mentioned earlier, and a schedule or formula of payments to the participant at retirement. In other words, what the participant actually is going to get, the distributions at retirement. The sponsor can be a wholly owned corporation. That's a big deal. That's under the Chen case. That set a buzz out, I think, in the judicial world. There was Judge Ellen Ahart, who was the ex-presiding bankruptcy judge here in Orange County, very respected. He sent a letter to the Uniform Law Commission in 1995 after this case, complaining that really there's a potential for abuse and they really need to put limits on the statute. And it was really a well-written letter, and nothing really resulted from it. And the case still stands as precedent. You can have a single shareholder, single officer, single director, corporation. In this case, it was a medical corporation in the Chen case. Establish a private retirement plan under the statute. And if you file bankruptcy, it works. And it did for this particular gentleman. And it's interesting, in the court's opinion, they made it clear that, look, if the legislator intended to limit the scope of the protection, it would have. Because in the case, it even referenced the fact that the defense complained that this particular plan, as small as it is, getting the same protection as a General Motors or an IBM pension plan. And the court was very clear in saying if it meant to limit it, then it would have, and it should. So it stands for the ability for a single shareholder, single officer director company to be able to establish a PRT and get all those protections and benefits that we talked about, the recharacterization of assets, the ability to get protected distributions, all of those things that we talked about. The PRT itself is a trust. It's a secular trust. It has certain discretionary provisions concerning emergencies, trapdoors, I call them, for medical emergencies, financial hardship, things like that. So it's not so static. It has a very almost apt construction in that it has a trust protector, it has a investment advisor, and has a lot of ability to be administered in a more efficient and forward-looking fashion. The trust is created for the benefit of the participant. The exemption is not the trust. The individual holds that, but it is the trust that administers the assets that are exempt. So we're clear. A lot of people ask me, is the trust exempt? No, but it is an exemption protection vehicle holding the exempt retirement assets. It has custom provisions and also provides for some forward-looking investments, including digital assets and currencies, things like that. They're very important with what's happening now in today's financial or TradFi environment. It does have policies and procedures surrounding funding and distribution, and certainly requires skill and proficient understanding of the creatures that are involved. There's I call them the animals, but really they're the instruments, right, that create these structures and how they should work together and what they should or shouldn't say to be able to enhance and ensure that its protection features are 100% utilized. And we have an adoption agreement that adopts the PRT. So that's the sponsoring company. It executes this agreement, adopting the plan, designates the participants, and specifies the terms like vesting terms, retirement age, and permitted contributions. I've had some clients ask for specifically the ability to contribute digital assets instead of fiat currency to either pay the obligation on their defined benefit funding agreement just as part of their overall bulk lump sum contribution. I think we're situated to be able to handle the modern planning needs. Let's put it that way. And Peak Trust is great because they understand all that stuff. Implementing the PRT, the implementation, its structure, funding, administration, it does require coordination and collaboration. Collaboration is a big deal with the team. I've always been of the belief that we work better as a village than we could ever work individually. And so the team works together very smart to be able to put these together in the most advantageous fashion for the clients. And that's our team. The Nestor would be the financial advisor, trustee, administrator. The administrator and trustee, in this case, would be Peak, and work with the other members of the team, if you will, our integrated team, to ensure that again, best result. And here's some assets that we typically fund. It's not all of them, but digital assets should be listed on here as well. But phantom stock plan benefits, supplemental executive SERPs, they're already retirement assets. They're just not protected retirement assets. Cash, stocks and bonds, life insurance. I'm a big fan of life insurance inside the PRT when it's applied for retirement purposes. It allows for tax-free growth. It allows for tax-free distributions. Should be a cash accumulation vehicle with a very low death benefit. I don't sell insurance. I don't benefit from any of the insurance play. It's just I find it a very attractive vehicle for protecting life insurance cash value at the same time, providing that tax-free growth and tax-free distribution element. Because life insurance, in the exemption for life insurance in California, cash value, it's like 15,000 and change, doubled for spouses. And I have a lot of high net worth clients that have, well, big chunks of money in their policies, and they're just sitting there exposed. So certainly something to think about. Real estate investments, no brainer there. That's all low hanging fruit for a creditor. It also creates some new planning opportunities with LLCs because the PRT will never take a naked investment. The other cool attribute is we fractionally actually transfer real estate into the PRT before it goes into any LLCs if there's real estate that hasn't already been put into the entities, which I like because you get a direct exemption on the asset itself, the actual real estate. So yeah, real estate is a no-brainer. If it's vacant land, not so much. We have to put things into the PRT that cash flow, or have a plan to be sold or liquidated, because everything in here we have to prove is going to contribute in some way to paying the retirement benefit. Notes, promissory notes, we work with the high net worth estate planning firms out there that they do beat it and other advanced structures that yield these promissory notes, like from beat it's the sale of assets to beat it's yield that beat it note. Note can be bifurcated or put into the PRT as a retirement asset, protect the stream of money coming out of it to the PRT all the way through to back to the participant. And unless that client needs that cash now, that's a great planning integration. Business profits, corporate stocks, notes receivables, commercial property, all those things are appropriate. Now, what's not appropriate? Right? With every good, there's always the flip side. The flip side is you can't put personal use assets into the PRT. I mean, cases I've seen where people try to put their houses into the PRT. It's not a retirement asset. It's not going to contribute in any way to paying your retirement benefit. It may contribute to your retirement, but it's not going to contribute to paying you a retirement benefit out of the PRT. Not appropriate. Vacation homes, same thing. Boats, they're just liabilities. I remember I had a boat for a little while, and it just as an aside, and we used to joke that boat stood for bust out another 1,000 because it costs so much to maintain. But anyway, they're not PRT assets unless they're charting a charter business and it's in a separate entity and there's some connection, maybe on ownership, where there's some cash flow. Jewelry, no, definitely not. That's not going to contribute to paying your benefit. Vacation, land, timeshares, Ferraris. I love that one. I had a client ask me, can I put my Ferrari in here? No, but maybe there could be some thought around how the Ferrari's equity could be pledged in some way to paying a retirement benefit. Security, that's a possibility. Classic cars, yachts, same thing. The annual administration is crucial. If you don't respect these plans, the court's certainly not going to respect them. We need to meet, or I suggest that a client meet with me or a team member once a year just to see how things are going. Got to keep our finger on the pulse of these. Things change. Client situations can get better and they can get worse. The good news, these plans are not static. They can be amended to keep up with the retirement need. That's their purpose. In fact, I like it because it shows more the intent, the subjective intent that this be a retirement asset, which, by the way, under the O'Brien case, the newest case that surrounds it, just a Ninth Circuit case, that's the first element determining whether or not a PRT is going to make it or not, is going to succeed or fail. And subjective intent, what was the client thinking when they created this? Was it done primarily for retirement or asset protection? These have to be done primarily for retirement, all right? And everything around it needs to say that and feel that for it to work. That's why I said this statutory exemption has a barrier to entry, and that's why we document the heck out of everything to make sure it's very clear. This is a retirement play. It just happens to be the best asset protection in California, bar none. Ensuring the funding, that's another thing, making sure they're paying their contributions on time. We send notices, our administration, Peak, they send out notices so that you make sure that you'll make your payments onto yourself on time. That's crucial. And we look at the retirement appraisal again, and in context with the plan participants' changing circumstances. Money making more money, acquiring more assets, you're making less money. Can we leave it alone? Are you in hardship? All of these things are realities, and the PRT can ebb and flow with these. The result, I believe, and the case law seems to agree, that when we do this right, we can protect the participants' retirement assets and recharacterize them as exempt under the law, under CCP 704.115B. The recap, just in a nutshell, the assets in the PRT only benefit from the exemption protection if we design and use these properly, we fund them properly, and we administer them properly and respect the rules and administration that we create around these, because I believe the courts will respect them if we do. And that's it for today's presentation. I hope everybody felt like they got something new from this. Hopefully you get excited about it as much as I am. I've been doing it now for a little while, but I still really do enjoy working in the space and talking about it. So if anybody's interested in a 30-minute complimentary, I call it my PRT primer, feel free. It's really this presentation in a nutshell, but it's great for if you have a client and you want to attend and show the client that you think may be appropriate this information. I have it down to 6 slides. You can call Sarah, my firm administrator, at the phone number listed on the screen, or email her and set something up. But in any event, thank you for your attention. I certainly appreciate everybody who attended today, and here's a resource. Thank you.